The main thing is if you can't manage debt, how are you going to manage this type of loan? Plus, if there's a rehab component involved, how are you going to manage the rehab?
Welcome back to the CashFlow podcast, the podcast where we talk about turning properties into profits. I'm your host, Jason Yoss. And before we get to my guest, I want to give a special shout out and thank you to our sponsors. First of all, Rainforest Plumbing, Heating, and Air, servicing all of the greater Phoenix Valley. And then Daniels Plumbing, servicing all of Southern California, including San Diego, Los Angeles, Orange, and the Inland Empire. Now, my guest today, Brandon Warnke. Brandon, how you doing?
I'm doing well. Thanks for having me on.
I'd love having you in. So, Brandon, you work over at Talmar Financial. Talk to me about Talmar specifically, what your focus is, and how long you've been doing it.
Well, once again, thanks for having me on. I really appreciate it. I've been a long-time listener, first-time guest.
Very, very true.
So
very
I
true.
appreciate it. I'm with Talmar Financial. We're a private debt fund here in San Diego.
Right.
Company's been around since 2008. And we're known for funding first position loans, quick closes, and being a local private money lender.
Fun fact about Brandon that you may not know, but he's also a master at jiu-jitsu. Got to throw that in there.
I would say master, but I'm a black belt in jiu-jitsu, so master. Still trying to master everything.
I got to shout it out because actually we talked about this earlier off camera. Like, this stuff translates into what we do in everyday life. Learning, whether it be any kind of sport or any kind of discipline, it also translates into our business world. Mm-hmm. And so there's a lot of takeaways there. Talk to me about how you found this niche. Why that debt fund. Hard money. Where'd that come from?
Well, honestly, I heard hard money. I said, "Dang, that sounds cool."
Right.
That's how I got into it. I started the whole story behind me getting into hard money was that I was working part-time for a hard money lending conference. It used to be called Pitbull Conference. Now it's called NPLA, National Private Lenders Association. Great conference. Learned a lot there. I was working customer support and security for them while I was still writing service for Honda, being a service advisor. So selling oil changes and timing belts and all that fun stuff. So, but I was also transitioning from that career into private lending. So got in good with one of the sponsors, a longtime sponsor of that conference. He reached out to me during COVID. Said, "Hey, starting up a startup. Would love to have you come along."
Perfect timing.
He was also a jiu-jitsu guy.
Nice.
So we immediately connected there. Learned a lot from those guys. Basically cut my teeth there, and just kind of learned where money comes from to actually fund these deals, and what happens after the deal is funded. Where does that paper go? So you'd be surprised on kind of how many hands that goes through.
Speaking about how to cut your teeth and learn in this industry, you had to have mentorship along the way, people to help guide you. Talk to me about how important that mentorship is and maybe some of the people who were those guides.
Yeah, mentorship's very important, obviously. At my first company, there's a gentleman by the name of Joe Neal, who's now still a really good friend. But Joe, super patient guy. I had 100 questions about everything, but he could tell that there was a fire in my eye, that I wanted to learn the business. Right. So he would just walk me through everything and just be super patient and kind of guide me in those steps. And we still talk to each other this day, and we still trade deals. It's always good to keep those relationships.
Yeah.
Everything ended, well with that company, but even if let's say it didn't, you just want to make sure you don't burn any bridges.
Sure.
And because you never know what's gonna come around.
There's too many people throwing
Yeah.
grenades all the time.
Yeah.
They want to burn everything down instead of that,
Mhm.
stoicism in terms of like, you know what? I'm going to take this. I'm going to learn from it. I'm going to move on.
Yeah. So Joe was my kind of first mentor. The second mentor obviously is the not to brown nose or anything, but Brock Vandenberg from Talamar Financial. You've probably seen him on social media, LinkedIn. He's all around there. He's been in the business since 2008. Um, I reached out to him through a local networking group called SDCIA, San Diego Creative Investors Association.
Right.
And I heard that he was looking for somebody.
Right.
So his underwriter actually left, and it was a perfect timing because I was just transitioning from my old company to a new company. I was specifically looking to join a fund.
Okay.
We can kind of go into why later, but Brock took me under his wing. He said, "Hey, I know you can originate, but I want you to start an underwriting first. That way you can really hammer home
Yeah.
how to look and analyze these loans."
That's such a great way to position a young new originator. It's like, hey, well, learn how the process works.
Yeah, absolutely.
Learn the entire aspect of when we're taken from soup to nuts and then go out and sell them.
Yeah. And this helped me avoid, shiny object syndrome. So get a call in on the sales line and, oh, I got a $10 million loan.
Yeah.
Oh, really? $10 million?
Yeah.
Okay, yeah, I want to do that.
You're picking it apart instantly now because you've been on the back end. Well,
Yeah. But now it's easily to weed through those type of requests. I mean, maybe it would have been a good request, but you can just tell by looking at, let's say, a property report. First thing you pull up and you see on the property report in the history, default,
Right.
notice of foreclosure. Then you know right there that's not worth chasing. So just simple stuff like that. Brock kind of, teaching me how to underwrite and
Right.
teaching me how to analyze deals.
and let's talk about
Really
what
helped.
is your philosophy on analyzing a deal, and what is your takeaway after being from behind the scenes and now in front?
My philosophy on analyzing a deal.
Mm-hmm.
Like what do we look for? What do I look for
That's
in a
right.
deal?
That's
Okay.
right.
So what I specifically pay attention to is credit. Everybody says, "Oh, you're a hard money lender. You don't care about credit. You shouldn't care about
That's what I was
credit,
going to
right?"
ask you. Like, shouldn't it not matter?
Well, it does.
Yeah.
The main thing is if you can't manage debt, how are you going to manage this type of loan?
If you can't make your monthly payments, like on other stuff, how are you going to make this one?
Plus, if there's a rehab component involved, how are you going to manage the rehab?
Yeah.
So that's the main driver for me. And then you go into experience. How many times have you done it?
Sure.
Even my specialty, I feel like right now is I really like working with first timers. So I'm
Okay.
happy to
Nice.
work with a borrower first time. And I have guys that there might be better pricing out there, but they come back to me because I was their first one and I was patient with them, and I can tell them if they're gonna make any money on the deal.
There's a
So-
niche for specifically what you
Yeah.
said. Like, if you got good credit, you're willing to help shape their experience for a first-time investor, first-time.
Yeah.
What would you call them? Developer or just kind of remodeler or what?
Investor.
Investor.
Yeah, first time investor.
I love it.
Yeah.
I love it. Let's dive into some specific case study style avenues. You have done everything, all kinds of loans. Let's talk about maybe a standard fix and flip and something that, how you found it and how you came to lending and what the outcome was.
So the majority amount of the loans that I have funded throughout my career with Talamar have been the fix and flip loan.
Okay.
We do other stuff.
Right.
So we'll do fix and flip. We'll do some ground up construction. The ground up that we're doing is mainly in San Diego County.
Okay.
And then we'll do commercial bridge loans. So short term interest only loans,
Okay.
where you're bridging the gap so the borrower can either sell it or build up those financials for that property so they can qualify for long term agency financing.
Got it.
So those are the kind of the products that I have done in my career with Talamar, but mainly I do fix and flip.
Okay.
So one of the fix and flips that specifically stand out to me is a recently closed one. It's actually on the cover of our magazine.
Nice.
Great again, this was a first-time borrower I met through in San Diego Creative Investors,
Right.
and he had a great background. It was him and his wife.
Okay.
He's actually a real estate appraiser.
All right. All right. So he's a
So
real estate adjacent, investment adjacent, for
yeah,
sure.
so he knows the main thing is one of the main things is being confident in your ARV,
Yep.
your after repair value. So he would come to me with realistic after repair values, realistic budget, and of course I just need the purchase price. So
Okay.
and a typical. I think his first one we funded 80% of purchase, 100% of the reno, and then yeah, it was. I mean, it went off without a hitch. The evaluation came in right on the dot, just as expected. So we didn't have to. It's always great when lender and borrower see eye to eye
Okay.
on after repair value.
Who makes that evaluation? You as the lender, or you use a third party company? So, or I mean, obviously we know the borrower or the buyer says like, here's what I think it's going to go
Yeah.
for.
Borrower's definitely going to want to know how to comp out a project,
Right.
but we do our internal evaluation. So
Okay.
we'll do our own evaluation depending on the loan amount. Now, once the loan amount starts to creep up to 1.3 million and over, then just per the guidelines of the fund, we like to get an appraisal just to confirm that ARV.
Got it.
Yeah, but we just we do internal evaluations, a desktop appraisal. I'm sure everybody's heard that
Sure.
term, but it goes pretty quick. It's primarily weighted on price per square foot, so to get a baseline, and then we make adjustments up or down, kind of based off that.
Love it.
But if it comps on price per square foot, I mean, normally it's a
gotta
slam
win.
dunk. Historically, we have had I would say, a 3% variance.
Got it.
And that allows
That's not too
most
bad.
private money, hard money lenders is speed. So you don't have to wait for an appraisal. It's speed to close. So
Sure.
everybody says we close in 5 days. So the only way you're going to do that is by doing an internal evaluation.
And talk to me about, okay, the process of lending, and you got to break it down Barney style for what is the borrower bringing to the table down payment? What is covered when we talk about like covering the renovation?
Yeah.
And what is this when you're talking about, well, I need to have 70% of ARV or 80%? Break it down Barney style for us.
Okay. So super high level. A fix and flip loan, especially for a first timer, you're going to expect to come in with 20% down on the purchase.
Okay.
So majority of these loans, I would say 9 out of 10, they're going to fund 80% of purchase, 100% of reno, up to 70% of that future value.
Okay.
So what happens is you'll come in with your 20% down. Normally, what we do, I don't know about other lenders, we want to see 6 months worth of payments
Okay.
in your account.
Got
We're
it.
not collecting those at close. We just want to see them in your account.
Sure.
Why? Because we want to make sure that you have some working capital to get started on the project, and then we need to make sure that you can keep up with the monthly payments.
Right. Because you're paying that loan every month, and that's in addition to the cost to swing hammers and fix things, the renovation.
So what's going to happen is you're going to close on the property. You're going to get in there. You're going to start your demo. Usually is the first thing. You need some money to start demo. And then what we do, let's say your budget's $100,000. We're going to, before we close, we'll work up what's called a draw schedule that everybody agrees upon, and we'll set that aside. You're going to close on the property. You're going to go in there. You're going to do your demo. We'll allocate, depending on your budget, it could be 5 or 10% of that 100,000.
Right.
Once you're done with the demo, you submit for a draw request, which is just a quick video and a web form through your portal.
Okay.
And then we wire it straight to you. Usually takes about 24 hours. And that's no BS.
That's awesome.
That's legit. I've seen it.
So if we budget out $100K for reno, each phase of the project that we already agreed on, they just do a couple of things to show that that phase has been met, money's wired, and they continue on.
Yep. Then they continue on to rough work, say framing, electrical, plumbing. Take a video, wire it to you. Then it's flooring, then it's drywall, paint. Once it's done, take a video, wire it to you.
Boom.
Usually for a first time, let's say flipper, first time flipper is what we call them. Every 100,000, you'll probably have 8 to 10 draws.
Got it. Got it. No, that's nice. And so at the
easy.
end of that, then we have a finished product, and that's what our ARV is. That's what we're putting it on the market at. Is that how we look at it?
Yeah. So once you're all done, you're listed on the market. That's when you get your final draw, and if you sell it for more than what the ARV came in, great. I mean, you just need to sell it at what, your target ARV is to make your profit.
What if you got less? What if they're like, hey, you bought it at $1 million, you put your 20% down, then you did $100,000 in reno, and you were trying to get 1.2, and they're like, sorry, like I can only get 1.1. Like, what do you do when a borrower comes to you and says, I can't get that number?
Well, they have to get it.
They got to get that number.
So they may not make. That's why we're at 70 ARV for first timers. We'll go up to 75 for experience, but that's why we have that cushion, because let's say their $1.2 million sales price came in at 1.1. Well, there's still some money. Like
Right.
you'll break even, maybe you'll lose a little bit,
Sure.
but there'll still be enough to pay off the loan.
That's what we're really looking at. There's got to be enough to pay off the loan.
There's some instances that I haven't personally seen them, but I've heard of, maybe in Palm Springs, out of state, I'm not sure. But if that sells for way below, then you're coming in closing
You're
with
bringing
extra
cash in. Yeah, right.
So it's rare, but
Well, let's talk about where it goes bad. I know it doesn't happen often, but I think you had a great line about Palm Springs.
yeah. So one that was not so great was a scenario in Palm Springs, and people love the desert. Why I don't know, but well, I do know is because price points are cheaper,
Sure.
so they can get in at a lower price point, and they think it's gonna sell for millions of dollars sometimes.
I think they're gonna make tons of money.
So this is not true for every Palm Springs deal or desert hot springs, but the desert is sometimes where money goes to die.
Palm Springs.
So one not so great scenario was just outside of, well, it was Palm Springs, but it was not in the heart of Palm Springs. It was sort of on the outskirts.
Like Rancho Mirage or Palm Desert or one of those.
Yeah.
Something like that.
And kind of told the guy it was first time flipper, bought it through a wholesaler.
Got it. And what does that mean for him that he bought it through a wholesaler? How does that affect the overall process?
Great question, because you got to be careful sometimes with these wholesalers, especially if you're new and you're kind of emotionally charged, because you think it's a great deal. You're going off the wholesaler's ARV. So what happened was on this particular one is that the borrower really liked the property. He really believed in it. He didn't consult a lender, or I don't know how he comped it, but he went off the wholesaler's ARV.
Right.
Now,
and the wholesaler said, hey, when you do all this work, you're going to be able to sell for X.
Yeah, like 500,000, right? Okay. So we're like, okay, I mean, it's a deal. But he submitted his earnest money deposit, which is non-refundable, in the amount of $20,000. So he's locked into this loan.
Yeah.
Whether or not he's going to lose money or not. So that just means he bought it off market, and the seller would only take cash or hard money. So quick close scenario,
Right.
which conventional lenders can't accommodate. Usually, I'm kind of going off in the weeds here, but another thing why conventional lenders can't fund most of these projects is because the property is in disarray.
Got it.
Holes in the wall.
Not going to pass a normal inspection.
Not going to pass the normal inspection. So back to your original question, what makes it different? So quick close scenario, purchased through a wholesaler, was locked into the deal already.
Right.
We came in as a first timer, by the way. I think I said that. But we came in, and since it was a little bit outside of San Diego, it was in the desert, not too hot on the desert, like I said before, but we'll still do it. It just means that you have to come in with a little bit more down just due to the risk. So he came in just over 25% down, and the deal still looked profitable. We did our ARV analysis, came back a little bit lower, but still, since he was putting money down, we're like, okay. But I did advise him, take another look at this one. I don't know if you're going to really make that much money, but he's a grown man. He decided he wanted to do it.
What would you recommend for somebody that's at that spot? Is there something specific you're like, look, in order to make this go off without a hitch, you have to do what?
In order for this to go off without a hitch, you have to stay on budget, and that ARV has to be true. Has to be realistic.
Got it.
So in a shifting market, say Palm Springs, those are the first properties that are going to decline in value because it's secondary market.
Does the contractor you choose have anything to do with the outcome, or does it matter who you get to swing a hammer?
Well, we don't choose the contractor, but the borrower, is going to choose the contractor.
Okay.
And you want to definitely vet your contractors and make sure that they can execute on time and on budget.
Is this something that when you're evaluating a deal or a loan, you're like, hey, that contractor gives us the red flags, go fix it, or we walk? Or is it normally like, hey, this is your make money or not make money, it's up to you?
Good question. For flips, it's you.
Okay.
It's all your judgment call.
Sure.
We don't require a contractor. It's nice to have a contractor, but a lot of these guys, are using subcontractors, which, hey, I would do the same thing too, but you just got to vet your subcontractors.
Right.
Now, when it comes to ground up construction, say you want to build 8 units in the backyard,
Sure.
and it's your first time doing it, then we need to vet the contractor.
Sure.
And if we see something in their background, then we're going to say, hey, we'll start asking questions.
Right.
Digging into their resume.
So as we just wrapping up the Palm Springs, like what, besides these red flags, what went wrong that really ended up costing the buyer or borrower on this deal?
Palm Springs, so the market shifted.
Okay.
And it sat on the market, couldn't sell, didn't want to take a lower offer. But the good thing was that he wasn't over leveraged.
Okay.
So he put a lot of money down on the purchase. So he was able to refinance that out with what's called a DSCR loan.
Got it.
Debt service coverage ratio. He did end up extending the loan.
Okay.
So it took longer to exit that one, but I think he did take a little bit of a hit.
Mm-hmm.
I don't have the exact loss. I think it was minimal, but if he holds on to it long enough, eventually he'll get it back.
The value does end up coming
with the
back.
rents.
Got it.
Yeah, and then now he's got tenants in there paying down his principal.
Got it.
So
there is, if you have enough money into the deal, you may be able to shift to a long-term hold while you're waiting for the market to change. Fair enough. As we talk about all the things that could go wrong, like what are the biggest tips that you're giving to these buyers and borrowers coming in? Like, hey, from where I sit, here's what you got to do in order to set yourself up for success.
So if you're a first timer and you're working with a wholesaler, my strongest tip is to, it sounds so cliche, but get pre-qualified with the lender. Right? And you're not just getting pre-qualified, you're just building that relationship so you can call your lender and say, hey, I'm looking at this deal in Claremont. I think it's worth 1.2 million. Like, tell me what you think.
Right.
Because the wholesaler is telling me it's worth 1.25, maybe 1.3. I think realistically we're at 1.2. Can you, do your analysis for me real quick, buddy, and tell me what you think.
Got it.
Let me know if it's a deal. So I've done that a handful of times. Now, back to the part where we have borrowers working with wholesalers, you just got to leave the emotion out of it. Like, don't chase the deal.
Yeah.
Just make sure the ARV's aligned before you put your earnest money deposit in. Now, if you need to go to the wholesaler and be like, hey, give me 3 days just to do a quick, let me get with my lender and make sure the ARVs line up, just do that.
Is there that much pressure where it's like you got to have it now? Like you don't have, then the minute you
Each
sign the
wholesaler is
contract?
different, but yes, some of them, there's some.
It's a great deal.
there's
Take
some
it.
companies
Yeah.
out there, and they, the classic tactic. We've got multiple offers. It's due tomorrow. This and that. We need your EMD today, or we're going on to the next guy.
Wow.
So you just got to be careful there, and then I would start just learning how to comp properties.
Right.
So either take a class on comping.
I was gonna say, is this a learned skill or is this just experience?
It's experience. It's having a good mentor.
Right.
Maybe your first, if it's
Art
your first
and
flip,
science of what we do, right?
yeah. If it's your first flip, you may want to partner up with somebody.
That's a great.
Yeah.
You trade some of that net profit for some mentorship.
Just think of it as tuition.
Yeah, I like that. Let's wrap by talking about mentorship right here. If you could get in the DeLorean, if you could go back to your beginning of your career, in this space, what What advice are you giving young Brandon as you get going?
Yeah, I sat on this for a little bit, just trying to think. And the main thing for me would be get out of your comfort zone.
Okay.
5 years ago, if you asked me if I would be doing a podcast on video, no way. Like, I'm not that guy. I'm not gonna do a podcast. I'm not gonna make Instagram videos. I'm not gonna make Instagram reels. I'm not gonna go to networking events. Like,
Love networking events. Yeah.
even my friends from back in the day, they're like, "You go to networking events?" I'm like, "Yeah, man. I go to a lot of networking events."
Yeah.
And just get out of your comfort zone, and don't be afraid to put yourself out there. So what? Let's say you make a silly a video where you stumble,
Yeah.
or you're on the podcast and you stumble a word or two.
Oh my gosh.
Dude, nobody cares.
Nobody cares. Nobody cares. People take themselves so seriously.
So yeah.
I love it. That is probably 60 plus episodes. That's probably one of the best life lessons to give. Like, dude, don't take yourself so seriously. Just get out of your comfort zone. Let's
Just
get going.
do it. You'll get better at it.
Yeah.
You could probably go on my Instagram and scroll all the way down. And
You have some great networking video reels anyway, by the way. So,
yeah, thanks. But my first videos were terrible.
of course.
Absolutely.
That's the way it
terrible.
goes, right?
So,
Brandon Warnke, Talmar Financial. Thanks so much for being here. Really appreciate it.
Yeah.
Everybody else, thank you again for joining us on the CashFlow podcast, where we talk about turning properties into profits. We'll see you next week. Thank you again.